Welcome to Talk Tickers. Today, we're digging into a really interesting one, Amdocs Q4 results. The company just reported a solid beat, but then the stock, well, it tanked. We're going to break down exactly what happened and what it means for the stock from here.
So, check this out. Amdocs comes out, beats on revenue, beats on earnings per share. You'd think, great news, right? Well, the market had other ideas and just hammered the stock, sending it down almost 8%. So what gives? That's the big question. This execution paradox we're going to get to the bottom of.
All right, here's how we'll break it down. We'll start with the headline numbers, then jump into the guidance, which is where things get messy. We'll look at exactly why the market sold off, and then we'll wrap it up with our take in the next call.
Okay, first up, the headline numbers. Let's see what they actually reported.
So on the bottom line, they reported non-GAAP earnings per share of $1.83. Now, it was a super narrow beat against what the analysts were expecting, but hey, a beat's a beat, right? And it was pretty much exactly what they'd guided for.
And on the revenue side, it's pretty much the same story. They pulled in $1.15 billion. Again, just squeaking by the forecasts. So looking at these two numbers, you're probably thinking everything looks fine.
But when you dig a little deeper, the story actually gets even better. Their pro forma revenue growth was solid at nearly 3%. And check out that operating margin, up a whopping 290 basis points year over year. I mean, on paper, this is a fantastic quarter. It's exactly what you want to see from a company. Which brings us back to that big question. Why on earth did the stock get crushed?
Okay, so if the results for this quarter were so good, the problem has to be about the next quarter or the next year. And that is exactly where the wheels came off. The forward-looking stuff, it really gives you this perfect split-screen view of the bull case versus the bear case.
Management, for their part, was really trying to paint a rosy picture. They were talking all about their strategic successes. The CEO, Shuky Schaffer, called fiscal 2025 a pivotal year. He's pointing to their big shift into cloud services, which is now a huge chunk of their revenue and brings in those sweeter, higher margins.
And this slide really lays it all out, doesn't it? You've got these two totally competing stories. On one side, the bull case, which is everything management was talking about. Cloud growth, new AI deals, great dividend hike, all good stuff. But on the other side, the bear case is what the market actually paid attention to, that weak future guidance.
Yeah, this is where the real damage was done. The guidance for fiscal 2026, it just wasn't what investors wanted to hear. Revenue growth looking kind of slow, EPS guidance for Q1 missing the street's number, and they pointed the finger at two things. A big customer, T-Mobile, is cutting back on spending, and their tax rate is going up. That's a nasty 1-2 punch that really soured the mood.
But it's not all bad news. You have to look at their backlog. It's sitting at nearly $4.2 billion. And what that means basically is they have revenue from contracts that are already signed, sealed, and delivered. This gives them incredible visibility into next year. About 90% of their revenue guidance is already covered. That's a huge sign of stability. So, you've got a good quarter on one hand and weak guidance on the other. How did the market balance those two things? Well, let's just say it wasn't a close call.
Yeah, the verdict was swift, and it was brutal. The stock went from trading around $84 before the call to just over $77 after, a drop of almost 8%. That weak guidance didn't just overshadow the beat, it completely buried it.
And this all happened incredibly fast. The good news hits at 4 p.m., an hour later during the earnings call, the bad news about guidance drops, and then, to add insult to injury, Wolf Research comes out and downgrades the stock the next morning. That just poured gasoline on the fire.
And just look at the trading volume. Over 4 million shares changed hands. That is 4 times the normal daily average. When you see a spike like that, it's not retail investors. That's a clear signal that the big money, the institutions, were repositioning and getting out.
So, the big question is, where does the stock go from here? Time for our take in the next call.
And this is really the fundamental question for any investor looking at Amdocs right now. Is this big drop a golden buying opportunity? Or is it a value trap, a warning sign that there's more pain to come? All right, so here's our call. We're initiating with a market perform rating. We think the stock is probably going to be stuck in a range for a while. Let's say between $75 and $82. The only thing that's really going to break it out of that range, in our view, is proof. Proof that their big push into generative AI can actually start moving the needle on revenue.
So our thesis here is pretty simple, really.
First, that cautious guidance basically puts a lid on how high the stock can go in the short term. Second, all this talk about GenAI is great, but it's a show-me story. The market is skeptical, and it's going to wait to see actual revenue before it gets excited. And third, honestly, the current stock price seems pretty fair. It's already pricing in that slower growth.
Now, if you're already holding the stock, what can you do? Well, one idea to consider is selling covered calls. Basically, you're selling someone the option to buy your shares at a higher price down the road, say at $90. It's a strategy to generate some income from your shares while you wait for the story to get better, and it fits perfectly with our view that the stock isn't going anywhere fast.
Okay, so let's tie this all together. What's the bottom line here?
Look, this is a classic story. Amdocs is actually doing a great job executing on its plan. The pivot to cloud, the push into AI, it's all happening. But the market doesn't care about what you did yesterday. It cares about what you're gonna do tomorrow. And that cautious outlook, that uncertain future, that's what's dominating the narrative right now.
And as always, please remember, this is not financial advice.